All right, let's start with a simple question. If Warren Buffett, the Oracle of Omaha himself, could only recommend one simple way to invest for the average person, what do you think it would be? Would it be trading individual stocks, chasing the hottest crypto, timing the market like a pro? Nope, none of the above. Here's what Buffett actually said. By periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals. That's right. The man who built his fortune analyzing companies thinks that simple wins over complicated when it comes to personal investing. But here's the thing. Simplicity is hard. We live in a world that makes investing feel intimidating. You've probably seen it. News headlines screaming about market crashes, flashy YouTubers pitching can't-miss stocks, and endless apps promising to make you rich overnight. No wonder so many of us feel stuck, anxious about where to start, worried about making the wrong move. But what if I told you there's a way to cut through all that noise? A timeless, proven strategy that's as easy as 1, 2, 3. One that Warren Buffett loves, and that many of the world's smartest investors quietly use to grow their wealth, with less stress, less cost, and fewer headaches. It's called the 3-fund portfolio, and it might just be the single best way for everyday investors to build wealth safely and steadily. So, what exactly is the 3-fund portfolio? Where did it come from? And why does it work so well? That's what we're diving into next. The story behind the 3-fund portfolio, and why it's so powerful. Hello everyone, I'm Loopvest. So, what is the 3-fund portfolio, and why has it quietly become a favorite among smart, long-term investors? Let's rewind to the late 1990s. In the US, a passionate community of everyday investors called the bogleheads was forming. Inspired by Jack Bogle, the founder of Vanguard and pioneer of low-cost index funds. They believed investing shouldn't be complicated or expensive. It should be simple, diversified, and built to last. Out of this mindset came the 3-fund portfolio, an elegant solution that captured the entire global market with just 3 low-cost funds. Here's how it works. First, the U.S. Total Stock Market Fund. This gives you broad exposure to thousands of U.S. companies, from massive giants like Apple and Microsoft to small, innovative startups. Second, the International Total Stock Market Fund. Because great companies aren't only in America, this fund adds global diversification, giving you a stake in businesses across Europe, Asia, emerging markets, and beyond. And third, the U.S. Total Bond Market Fund. Bonds provide a cushion of stability, protecting your portfolio when stock markets get rocky. And that's it. Just 3 funds, giving you exposure to thousands of companies and a balanced mix of assets. Now, why does Warren Buffett admire this approach? Simple. Because it's low cost. Index funds charge tiny fees, leaving more money in your pocket. Passive. No need to constantly trade or time the market. Highly diversified. Reducing risk by spreading your bets across the entire global economy. In a world where complexity often leads to anxiety and underperformance, this strategy keeps investing calm, clear, and effective. But wait, if it's so simple, why don't more people follow it? That's what we'll unpack next. Why Buffett believes this simple strategy outperforms, and why so many investors still miss it. Here's the big question. If the 3-fund portfolio is so simple and so effective, why don't more investors follow it? To answer that, we need to look at how Warren Buffett thinks about investing. And trust me, his insights here are pure gold. First, Buffett knows that most professional fund managers can't consistently beat the market. In fact, year after year, the majority of actively managed funds underperform basic index funds. Second, high fees kill returns. Many actively managed funds charge 1% or more in fees. Now, 1% might not sound like much, but over decades, that tiny number can eat away a huge chunk of your gains. Buffett often says, "Performance comes and goes. Expenses never go away." Translation? Low costs matter. A lot. Third, complexity is seductive, but dangerous. The financial industry loves to sell us complicated strategies, hedge funds, structured products, exotic ETFs, because complexity feels smart. But Buffett knows that in investing, simple usually beats complex, especially for long-term success. And here's the kicker. The data backs him up. Over the past 10 years, a basic S&P 500 index fund has outperformed more than 85% of actively managed U.S. equity funds. In short, most pros don't outperform. High fees quietly destroy wealth. Complexity adds risk, not returns. Simple, low-cost investing wins, if you stick with it. And that's why Buffett believes in this approach. It puts the odds in your favor. So now you know why it works. But how do you actually build your own 3-fund portfolio? That's what we're diving into next. A step-by-step guide to building your first 3-fund portfolio. All right, now you know why this strategy works. So let's get practical. How can you build your own 3-fund portfolio? Step 1. Choose your funds. The beauty of this strategy is that major brokerages make it super easy. Whether you use Vanguard, Fidelity, or Schwab, you'll find excellent options. Here's what you're looking for. U.S. Total Stock Market Fund. Covers the entire U.S. stock market. International Total Stock Market Fund. For global stocks outside the U.S. U.S. Total Bond Market Fund. For stability and income. At Vanguard, for example, these are popular choices. VTI for U.S. stocks. vxus for international stocks, BND for bonds. Step 2. Pick your mix. A classic starting point is 50% U.S. stocks, 30% international stocks, 20% bonds. But this is where you can customize. The general rule of thumb, the younger you are, the more stocks you can hold, because you have time to ride out the ups and downs. Buffett's timeless advice? Stick to your plan through thick and thin. In other words, once you've built your 3-fund portfolio, leave it alone. Don't tinker with it based on headlines. Don't chase hot stocks or trendy sectors. Common mistakes to avoid. Don't jump in and out of the market. Don't constantly rebalance to chase returns. Don't panic when markets dip. That's when long-term investors get ahead. And that's it. Simple to understand, simple to manage, and incredibly powerful over time. So, ready to take the next step? In just a moment, we'll wrap it all up and show you exactly how this strategy can help you move closer to financial freedom. Your next step toward financial freedom.
So, we've come full circle. Today, you've seen how one of the world's greatest investors, Warren Buffett, favors simplicity over complexity. Let's recap the core ideas. Simplicity beats complexity, because clear, consistent strategies win long-term. Controlling costs is critical. Fees eat away at your returns more than you think. Staying the course is your greatest edge. The market rewards patience, not panic. Now here's a question for you. Is your portfolio as simple and as effective as it could be? Or are you chasing shiny objects, trying to time the market, or paying hidden fees without even realizing it. The truth is, the 3-fund portfolio may not sound flashy, but it works. And if you commit to it, stick with it, and let time do the heavy lifting, you'll be amazed at the results. If you enjoyed this breakdown, and you want to learn more about smart, simple investing, don't forget to like this video, subscribe to the channel, and join our LoopVest community, where we break down the markets and help you invest with clarity and confidence. And hey, I'd love to hear from you. Drop a comment below. What does your portfolio look like right now? Are you using a simple approach, or do you see room to simplify and improve? Remember, every great financial journey starts with a single smart step. You've already taken that step today. Now, keep going. Coming up next, how to actually build your first portfolio with these tools.